Friday morning, are we in for a bounce? Market technical conditions are looking slightly oversold, so are we in for a technical bounce? It's a lot of green on the screen, mid cap, small cap, and the market breadth. So from where we were same time yesterday versus where we are, there is a big change both in terms of the market mood and also in terms of basic approach. I always say that don't go short on India, and isn't that getting more and more validated? Okay, now what do we have? We've got PNB which is up. We've got Reliance Power which is up. We've got Zomato which is at 108. We've got Bank of Maharashtra. So the tiny tunes in the market, the real chotu, mid and small cap stocks, they are the ones which are bouncing back the fastest. Now let's look at some value stocks in terms of where the transaction I think seems to be high. So transaction is high in HDFC Bank, it's high in Axis Bank, it is high in Reliance and Dixon. Then in terms of absolute percentage gains, I'm just reading the screen here guys, just bear with me. Simple reading of the screen. Well, very strong market breadth, that's what I can say, because rather than getting into individual names here, all I can say the market breadth I think is explosive today, and there seems to be sea change in where we were yesterday versus now. But the stock which I want to revisit is actually Bombay Stock Exchange. Because of the sheer outperformance and because of yesterday's recovery, where is BSE? I think it will be up. It's not coming up on my screen, but I can guess it. There you go, 3.5% higher for BSE. It has pretty much knocked off whatever it has lost in that 2 day of correction.
Okay, lots of other earnings, and Dixon Technologies, the earnings are clearly above estimates. The mobile segment has seen a revenue jump up of 77%, 2.5% higher for Dixon as we speak right now. Vodafone Idea, of course, the net loss has widened quite a fair bit, but their margins also have risen actually 100 basis points. So about 0.5% uptick is what you're seeing on the stock, and the 4G subscriber base has seen an uptick of 1.5%. Of course, starkly lower than what its peers, Jio, or for that matter, Bharti report. But then again, it has an improvement of sorts. Shriram Finance numbers have been very strong. It's a beat all across. We were flagging this off in the morning as well for you. Shriram Finance will just come up for you on your screens. A 6.25% gap up on that stock. We'll be chatting with the management as well shortly on the show. There's also RailTel. The revenues are higher by 40%. The EBITDA jump up of 15%. That stock as well has made a move of about 2% right now. Home First Finance came out with its numbers, an AUM uptick of 33%. Aavas Financiers, NIMs remain above that 8% mark, and the ROAs are at a 3.25%. Aavas Financiers also holding up about 1% as we speak right now. Karnataka Bank has raised about 800 crore rupees via preferential allotments, so look out for that stock as well. And I just want to see what Sun Pharma is up to, because remember, Taro has reported a strong second quarter. The numbers came just a short while back. The operating income has come in at $4.7 million versus a loss of 6.8. Not quite rubbing off really on Sun Pharma, but it's in the green nonetheless. Now to the beleaguered ones from yesterday. Let's see what they're doing. The likes of Bajaj Finance, Asian Paints, M&M, they were the heavily beaten down names from yesterday. They're all holding up and seeing a mild bit of recovery take place. But is the recovery looking sustainable, considering where, yes, we've climbed up back above that 18,900 mark and a meaningful comeback for the broader markets as well? But Shivangi, what is your sense about... Okay, we will get our chartists in just a bit and get in their expert comment. But let's take it across to Devina Mehra. She joins in on the show right now. Devina, hi, good morning. Good to have you on the show as always. Devina, what explains the near capitulation that we've seen all through this week? Truncated one at that, had expiry as well. Were we falling under our own weight, aligning with the rest of the globe? What explains this?
Good morning. What explains it is what I call the theory and practice of equity markets. So in theory, if you ask anyone, they will say, yes, equities give higher returns, but they are more volatile asset classes. But when you're living through the volatility, it seems as if it's the end of the world. I mean, it is not. I was just looking at, for example, our small case, and for the past 1 year, it's up 35%. Yes, 8 days ago, it was up 42%, but am I unhappy with the 35% versus the benchmark 10%? No, I'm not. So this is the nature of the beast. As they say in software, it's a feature, not a bug. That is the way equity markets are meant to be, that you will have corrections. And all the people who at 20,000 were saying that we will we'll wait for a correction to get in. I hope they are getting in, so that's the other part of it. And even this is an example I often give, that people think that Rakesh Jhunjhunwala's superpower was identifying great stocks. I think his superpower, which was like that one line in the book about him, was that he said that I made a lot of money in 89 to 92. I made a lot of money in 2003 to 2007. But there were periods of even 4 or 5 years in between when I didn't make money. So to really understand and be able to live through that, that equity markets will not give equal returns every year or even every decade, that you have to understand. And whereas, I mean, if you look at the mutual fund data, most investors don't even, I mean, this is the majority of the investors, more than 50% of the investors don't remain invested for even 2 years at a time. So the compounding doesn't show up for them. It shows up on, or when we look at the long-term equity charts, but it doesn't show up for equity investors. So this much of volatility is par for the course.
Devna, if I look at the market positioning, it's quite unique. Retail activity strong, SIP flows robust, but the FI positioning in the cash market and the FNO market is just telling us a very different story. We are perhaps for the first time staring at two parallel markets where foreign investors who've always bought into India, they don't have a great positioning in terms of commitment, and retail investors who always, in a sense, harbinger of creating a market top, they are the ones who are really, in a sense, in the front row.
Actually, I would like to characterize this sort of two-tier market differently, rather than from the investor's point of view. As I've said earlier on your channel also, not only is there no causation, meaning if FII flows go up and down, the market doesn't go up and down along with that, never has, even when FIIs were a much bigger proportion of the market than they are now, when mutual funds are large, direct retail participation is also much larger. The first time FIIs came in from 94, the market went nowhere for 9 years. That was the only 9-year period when the markets gave net zero return. I mean, it went up and down, but net zero returns in spite of this new slew of money coming in. But the part what I was talking about, the two-tier part, was that you have to be more careful on the small caps. I said it the last time I was on your channel as well, that the small cap is the risky end of the market. And I have begun to see these kind of things, that so-and-so fund manager has given 60% compounding in small caps for the past 2 years or 2.5 years. And people forget that percentages are not symmetrical. If a small cap index falls 80% as it did in 2008, 2009, it can go up 5-fold and you will have zero return at the end of it. Or 2018 crash, it went down nearly 2/3. If it goes down 2/3, it triples and still you are at the same place. And you're actually not even at the same place, because the small cap index itself churns so much that the stocks that finally make that cross that high again are a completely different set from the stocks that fell. The stocks that fell, a lot of them just go out and go to zero essentially, stop trading, etc. So that part of the market I've been saying for the last month and a half, that's where you have the real risk part. The large caps, of course, you have to choose the sectors carefully, you have to choose the companies carefully, but a market as a whole, the reason why the risk is not so much is, as I said, decade to decade returns are very different. So in the 1980, if you had put in 100 rupees, after 10 years, you would have got 700 in Indian equity markets. In 2010, if you had put in 100 rupees, in 2020, you would have got only 230 rupees, barely beating FD returns for that period. So you came so far below the trend line that you are still not anywhere close to the trend line. So the big crashes come when you're way above the trend line, as you said, or the froth. So that's not happening. And even if you look at retail SIP flows, they have been very targeted towards the small caps. So the net flows have all been to the small caps. So that's where the frothiness has built up with mutual fund, the small cap mutual fund, which may have been investing in a universe of 100 stocks, is now has to look at 200 or 250 stocks just to invest the money that is coming in, which means criteria getting diluted, and that's where the risk comes.
Morning. We were just having an interesting discussion earlier today about the outlook when it comes to banks, private sector banks in particular, given that they seem to be in a very ripe position to buy at the current levels. Would that be a view that you concur with, given the fact that the growth is there, visibility is there, NPA concerns are behind us, and valuations as well look attractive?
Not really. And somebody tells me that social media that this is something you repeat in every interview, that I'm a nervous investor in banks. So I mean, I and my systems also don't still like private sector banks. In fact, the last rebalance we did, we cut back banking in general, and within banking, again skewed little more towards PSU banks. And I'm not so sure that, everything is that hunky-dory also, because you now see there's a lot of growth in non-housing bank credit and retail. I'm talking not corporate credit, but retail, basically personal loans, non-banking personal loans. And I'm not sure, some part of it obviously is because more luxury homes and luxury cars are getting sold and getting financed. But I think there's also an element of people with not enough income funding consumption via these loans. So, that's one area where I would like to keep an eye in terms of where that goes. So, I mean, we are not yet saying that pull the trigger on private sector banks. And banking, I mean, fundamentally for me, it is always that you don't know where the negative surprises are lurking, and periodically there are negative surprises in that sector.
Devina, the interesting macro data for all of us has been the US GDP data. Beginning of the year, the assumption was it could be a soft landing, it could be a mild recession. If I get recession, I mean, that economy is blooming. 4% plus for a size of US, I think it's like a economy is in some kind of an, bull run. What is the importance of US economic growth? What does that mean in terms of sectoral positioning for global facing sectors like IT, pharma, exporters, metals?
So, I mean, as far as US is concerned, I mean, they have had a much softer landing than, frankly, I was expecting, because the Fed also has been trying to bring down the growth and the, if not the GDP growth, even the labor market, how buoyant it has been, and that has not changed still. So, I mean, that part still remains good. So even inflation has moderated somewhat, but beyond that, it is not coming down because the economy is not slowing as much as the Fed would like it to and that still remains. As far as India is concerned, I mean, we are not such large players, except probably in IT, that that overall that global or at least the US GDP plus minus will make a big deal for us, because we've not been doing well in exports at all anyway for the past 10 years or so. And the pharma exports are anyway not so tied to the GDP plus minus 1-2%, because and if anything, theoretically you can say that if there's a recession, people will want cheaper pharma, and therefore it will be good for Indian pharma if you want to, I think it's a little bit of a stretch, but if at all the logic runs, that's the way the logic would run. IT, I see a lot of press saying that the hiring is slowing, and so I mean, I think you're mixing up two things, that whether what's happening on the job market and what's happening on the demand side, which are two different things. So it may be that you are automating more, and not maybe, I mean, they are automating more and using more AI, etc., and therefore will need fewer bodies. That doesn't necessarily mean the business outlook is bad. It might even be the other way around. The business outlook is good, but to me, the slowing down in IT hiring is more of a concern from the Indian economy point of view, because the last 20-25 years, a lot of the growth in the Indian economy has been driven both directly and indirectly by IT hiring, because each person that they hire also has a effect on the economy around them by hiring maybe domestic staff and so on and so forth. So if that slows, that can it's not going to happen in 6 months, but I'm saying over a period of time, to me, that would be a concern because this has been such a big direct and indirect employment generating sector.
Thank you so much for joining in, Devina. Good to have you as always, sharing with us your thoughts on air. All right, just quickly checking in on what the market is up to. And at first glance, we're up about 0.6%, and it seems to be gains coming in across the board. But Canara Bank joining in and the management with us. We've got Satyanarayan Raju, who's the Managing Director and CEO with us on the show. Thank you so much for taking time out. Mr. Raju, start by talking to us about the cost of deposits. Do you think that they're at their peak or close to it? And will net interest margins hold above that 3% guidance?
No, we can't say that it is we have reached to the peak and all at this moment, because the whatever you new deposits what we are procuring at market rate that is more than 7%. So when it comes for that average, whatever for meeting the requirements of the current year credit demand, we mobilize the deposits either in the form of retail term deposits or in the form of low cost deposits, CASA. But the CASA is growing because of our initiatives, but it is not in the same pace what the term deposits are going, retail term deposits are going. Retail term deposits are growing much faster than the CASA. That's why the retail term deposits are attracting a 7% average rate of interest. So when you are mobilizing majority of your resources from the retail term deposits, there is a chance that little bit upward movement may be there in the cost of deposit, which may impact on our margins.
Good to hear that. So where and when will NIMs bottom out, you think?
What we are expecting is it will be around 2.9.
Okay. And when can we expect the NIMs to bottom out? Sometime you would think in FY24 itself?
No, that depends on the liquidity availability in the system. The liquidity availability is improved in the coming months. It may not be that immediately. Otherwise, it will be in the next 2 quarters. It will be there.
So can we continue to expect deposit growth to accelerate, and would you maintain your CD ratio at 75%?
Correct. That's we have a comfort of reaching to that CD ratio at 78%. Actually, that is you can go up to that benchmark level. We have still the cushion of 3% in our system. To take that advantage of that, we were little slow in the deposit mobilization. And what the slow means, it's not the below the what we are given the guidelines. We are given the guidelines at the start of initial start financial year. We are given a guidance that at 8% we will grow in the deposits. Now we are growing at 8.66%. And whereas what we are given the growth, advances growth is 10.5, but in my interactions with the media and analysts, we confirmed that the current year credit growth will be around 12 to 13%, and we are growing at that 12%.
All right. And given that the Reserve Bank has expressed concerns on unsecured, are there any concerns that you're looking at? And, what about growth here for you?
No, actually, the concerns, whatever the expressed by the regulator, is not related to the total your unsecured exposure. Their concerns are speed growth or fastest growth in unsecured retail portfolio. From our side, in Canara Bank, we don't have such issue. We don't have such schemes that to give unsecured loans to the non-customers or the customers who are not even a salaried class or like that. In our case, Canara Bank, our schemes are very clear that they get the customers who are salaried employees and whose salary is being credited to the Canara Bank. Only those guys will get the unsecured loans. That's why we don't see any stress in that, and our NPI in that sector is only less than 2%.
Right. And what part of your loan book is unsecured?
No, that retail book as on date is only around 8,000 crores.
Okay. Could you also tell us about your recoveries and how are you placed? What is the goal for FY24?
Yes, actually current year, the current quarter, what the cash recovery towards the book balance is almost touching the 3,000 crores in the current quarter. In addition to that, there are upgradations up to almost to 670 crores. But as against this 3,700 crores, the slippage is only at 2,900 or 3,000 crores. So we are much above than the slippages of our recovery. The current strategy that your slippages should be less than your recovery and the upgradations will continue. And in initial stages also, we are told in the current year, our recovery will be more than the slippages, and our expectation of slippage will be around 12,000 crores in a year. So our recovery will be more than that 12,000 crores.
On ECL front, there was an assessment which you were making through an external advisor. What is the report out? What does that number look like? We heard it was around 2%. Is it true?
At this moment, still the report is yet to come, and the RBI has constituted a working group. In that, Canara Bank representative also is a member in that. You can find out that's that. And we are sure with all those things, whatever we are told that 2%, it may not be beyond that.
Given there is a possibility of a decline because interest rates have picked out on NIMs, do you expect that it could have impact on your ROA as well?
No, at this moment, we say that we will maintain that return on asset will be more than 1%. The exactly number and all, let us see that the next 2 quarters. But our endeavor, our main strategy, our target is to maintain above 1%.
And tell us a little bit about your equity fundraising. Do you have any plans given that growth is strong?
See, fundraising, it is one is the capital side, another is bonds. The capital side, the CET1, we are very comfortable. And even if you look at total CRAR, we are maintaining well above 16%. Among it is better than all the peer banks. You can compare with those things. Even such a credit growth, robust credit growth, we are able to maintain more than 16% with the internal accruals only. But the board has permitted us to rise up to 7,500 crores, 3,500 crores towards the 81 bonds, and the 4,000 crores is tied to bonds. But the management, top management, we are waiting for a right opportunity. We don't want to shell higher margins because we are very conscious on the interest spending. So whenever such market conducive is there, we will come out and raise that funds. Otherwise, it's not necessary for us that immediately we have to rise because we are already well equipped with that enough CRAR. Regarding the second one is bonds rising. You might have seen that recently we are successfully raised 5,000 crores in infra bonds at very much competitive pricing of 7.54 for 10 years. And it was subscribed almost 3 times. And board has permitted us to rise up to 10,000. We have raised 5,000. The remaining 5,000 also we may raise it because that will give us a benefit in the form of LCR and actually these bonds, that it will not be subjected for the CRR and SLR. So effective rate will be much less than what we are paying it.
Right, and your OPEX as well has seen a very sharp rise due to staff costs too. Do you expect it to stabilize here now? Other operating costs seem to be largely steady.
No, staff cost is not increasing. It's not that the whatever any burden is there on that. We are very proactive in providing the provisions. See, our staff are their bipartite settlement is due for settlement from November 2022. So last time when the bipartite settlement has happened, the expected the incremental growth was around 14 to 15%. So by taking that as a clue for 15%, we started providing from November onwards, so 15% on every month on month. This particular quarter also we provided 345 crores. And as on date, we have provided almost 1,150 crores only to meet that future. When the bipartite settlement has happened, we have to pay the arrears. That should not be a burden on any specific quarter. To meet that requirement, we are accumulating that provisions. That's why it looks that the staff cost is increasing it. The second one is the operating expenses. The operating expenses, since the beginning, our bank operating expenses are under very much control. Last 2 years, you might have seen that there is a drastic reduction in these operating expenses. That tendency will continue even in future. Maybe 2%, 3% here and there is there because we are investing heavily on the capital investment on the technology. once you are investing in the capital expenditure on the technology, next year onwards, it may reflect in some maintenance charges, ATS charges and all. But still, we are confident that our operating expenses will be well within our control.
Appreciate your time. Thank you so much for giving us that clarity on Canara Bank. With news that the index is touch and go with the 19K mark, we'll take a very quick break right here on the show. Stay with us. On the other side, we talk a little bit more about navigating the market volatility with Pankaj Tibrewal, who will be joining in from Kotak Mutual Fund. Thanks for staying on with us and just checking in on the markets. A little bit of a rebound evident, ditto with the broader universe as well. So let's understand whether or not it's meaningful, whether the undertone of the market is still looking pretty choppy, and how one can navigate the volatility. We've got Pankaj Tibrewal now joining in on the show. And Pankaj, what really is going on with the overall market at the current juncture? What do you believe could be the key reasons for the fall that is stemmed in the markets? Do you think that it's largely on account of the fact that we have seen a ferocious run up on the upside, and where do you see us headed?
Good morning. If you kind of recall, we have been a little cautious on the broader market space for some time now, and our broader concerns were that the valuations had become too rich, and greed was clearly visible on the street, and money making had become too easy. Over the last decade, mid and small caps have been the best equity class. And we believe that some exercise and some caution needs to be warranted in the near and short and near term. We believe that there are 3 or 4 data points if you look at. The first one, if you look at September 12th, the first crack when happened, the breadth of the market has been deteriorating since then. In the month of September itself, the first indicator was that after March 2023, the median stock return of small cap index was negative, whereas the headline index return was positive. That means that the rally was getting narrower and narrower. And on Monday this week, we saw that the market breadth was one of the worst, with more than 1,200 stocks declining or having a drawdown of more than 3%. The second point, if you look at, is that if you look at the market cap distribution today, the mid and small caps together are about 35% of the overall market cap. Large caps have come down to 65%. But on the other side, when you look at the profit distribution, still the top 100 companies are about 75% of the profit pool, and mid and small caps are about at 25%. So clearly there's a disconnect between the profit distribution and market cap distribution. The third point, if you look at that, the large cap shares in the overall market cap has come down to one of the lowest levels. Even if you look at large cap market cap ratio versus GDP, it has come down to very reasonable levels. And we believe that some, a rotation may happen from mid and small cap in the near term towards large cap, which are in a much better valuation zone. Last but not the least, if you look at, I think from a overall perspective since 2021, large cap market caps have gone up by almost 12 to 13%, whereas the profit pool has gone up by almost 40% on an absolute basis. So we have seen some kind of a derating in large caps and equal amount of re-rating or larger re-rating in mid and small caps. So I think in the near term, we believe that there's some caution which needs to be exercised in this space. Everybody is looking at the past 3-5 year returns and believes that small and mid caps are the path to financial nirvana. But we have seen cycles, and we know that such situations do not last for long. Cycles have become shorter and sharper. And in order to create wealth in the long term and medium term, we need to navigate short term also with caution.
In your emerging equity fund, help us understand or give us some color at least as to what have been your recent exits. Have you added any names in the recent correction that's played out?
Yeah. So if you look at, from the past cycles, there have been few learnings, and look at 2007-8, look at 2013-14, look at 17-18. One thing which always, is very important is the anchoring to quality. And I think we have not compromised on that. And the basic tenets of our investing remains quality, and making sure that we don't invest in momentum, we don't invest in broken balance sheets, inferior cash flows. And I think that's something which goes on for this cycle as well. Avoid leverage, avoid businesses which are financially levered. And I think that's something which is, again, a very important thing. Keeping those basic things in mind, I think first, I think the filter is that the entrepreneur, the management team should have seen cycles. And most of our investee companies in our portfolio have seen, at least 2 decades of different cycles and have come out stronger and sharper in that. So that's a big comfort that if anything goes wrong globally or locally, management teams are equipped enough. Second, if you look at the overall return profile, I think that's very, very solid at about 17-18% return on equity, return on capital, and cash flow seems to be very strong. And X of financials, the overall aggregate portfolio have a very low leverage as well. So those basic things have been kept in mind. And we believe that pharma is a decent spot. We have been increasing exposure over the last 6-7 months. Financials are in an interesting space today. Valuations have corrected, and we believe that financials also warrant a look post the derating which has happened over the last 12 to 18 months, especially in the larger names on the private sector banks. The third point is the manufacturing side. We believe that the traction continues, the order inflow continues to be strong, and that's another core portion of our portfolio, which will cover different parts, which is capital goods, cement, chemicals, and so on and so forth. Pipes, which is another core part of the infrastructure. Last but not the least, incrementally, we believe that the earnings downgrade cycle in IT could be behind us, and we believe FY25 could be far better than FY24, and we are looking at opportunities in the IT space incrementally as well.
When you say that the cycle in mid and small cap stocks is getting over, should one redeem the units and shift to large cap? A very straightforward and a frank question. It's about asset allocation.
Nikunj bhai, if you look at, I'm not saying cycle is over. We believe that 3-5 year, if economic growth was to continue, this is the best way to play. But medium and long terms are made of short term as well. In the short term, we believe that there's some froth in the space which needs to be cleared out. There could be sharp drawdowns, which we have seen. For example, look at after 2017, there was 2 years of consolidation in 2018-19, where Nifty didn't correct that much, but there was a huge drawdown in 2018 and 19 in the mid and small cap category. When he was sitting in 2017, nothing seemed to have gone wrong, right? But 2018, different sequence of events started panning out, and we saw that finally data doesn't lie. On the hindsight, we come to know the reasons the reasons are there. But today, the data points are similarly pointing out that there has been excess created in the small micro caps, mid caps. Greed is visible on the street. Look at the ISME IPO side, the way the stocks have moved up in the last 12 months or so. So I think that needs some caution. And from a tactical opportunity and asset allocation, what we are advising to our clients is that have some discipline out there and move incremental capital to large caps, which are at a much reasonable valuation zone compared to mid and small caps.
That point of yours, which is a profit pool and market cap, it's a great point that the profit pool is with large cap and market cap right now in terms of the division is with small and mid caps. But what about the absolute earnings growth? Large cap, according to estimates, will grow in the region of about 13 to 16 or 14 to 17% depending on the estimate you have. But for mid and small cap stocks, that number in terms of the rate of growth is far higher. So it is a shift which I think market could prioritize.
Excellent point, Nikunj. Look at 2 data points. The first one, if you look at profitable companies, apple to apple comparisons, you have seen a derating in large caps and a sharp re-rating in mid and small cap. However, the aggregate number gets completely, misrepresented because there's a lot of loss pool which are sitting in mid cap index and small cap index. And when the loss pool comes down or moves from loss to profit, the aggregate headline profit growth seems to be very large. And that's what is happening in this year, FY24, and probably early part of 25, which is exciting the market. But what we do is we normalize those earnings which are more volatile in nature. Let me give you a small example. If there is a telecom company which is a part of mid-cap index and it reports a loss of say 60,000 crore last year, and if that loss comes to 30,000 crore, suddenly you see that the headline mid-cap earnings growth is looking very strong. But you need to normalize that, because you know that probably that's not where you will go and invest in. I'm giving you a small example in that respect. And there are many other companies, even in the small cap index, which had a bad last couple of years. They are moving from either loss to profit, or the loss is coming down. So you need to adjust for that. And hence, I think that the differentiation or the difference between large cap growth and then if you adjust the mid and small cap index growth is not that very large.
Where in the mid-cap space, you mentioned manufacturing as a theme, you mentioned financials as a theme. You think that we are in for high growth and valuations, they are supportive? Because manufacturing is not cheap. I mean, the exception of private banks, nothing is cheap in this market. Where you are getting a comfort that, okay, I'm not going to be getting it, I'm still getting it cheap and the growth looks decent.
Very limited pockets of that kind of opportunity, Nikunj, to be honest with you. Financials are one space which are quite reasonably valued. And look at one data point. If you bifurcate NSE 500 universe, which is largely what market represents, into two buckets, which is BFSI and non-BFSI. And BFSI are 77 stocks and non-BFSI are 423 stocks. Today, the non-BFSI bucket is trading at an 85% premium to the BFSI bucket. That means that the entire non-BFSI space has been massively re-rated over the last 12 to 18 months or 24 months. Whereas the BFSI, despite of delivering strong earnings growth, has not seen that re-rating. On the contrary, there has been some de-rating in the large private sector banks. So I think that's one space where a lot of comfort could be derived on, and they are delivering on numbers. The second point, if you look at from a overall perspective, if you look at this quarter numbers, till day before yesterday, 90 companies have reported out of the NSE 500 companies. The aggregate profit growth is about 28%. And if you bifurcate between BFSI and non-BFSI, again, out of that 90 companies, 28 companies in BFSI space has delivered 40% earnings growth, and the rest 62 companies on non-BFSI have delivered 18% earnings growth. So it's not been that large. And the third most important point, don't forget that in this quarter, whatever little the numbers have come through, we are not seeing any top line surprises positively. And don't forget that the base quarter last year was the worst margin corporate India has seen in their last 20-year history. So margin expansion is happening, but there's no joy in the top line growth of all the numbers which have been reported. As you move into the third and fourth quarter, raw material, crude have all started inching up, and we need to keep a close watch on how the margin trajectory spans from here. So very little pockets where you think you can go with very high conviction, where valuations are also supportive and growth is also happening. Markets have become smarter in re-rating it very fast. And financials are the one place where we are seeing that opportunity is there, especially in the larger cap banks.
Pankaj, great to have you on the show and get in all that insight from you on how to navigate this weakness within the mid and the small cap space in particular.
Thank you.
We will take a very quick break on that note. What you can see on your screen, of course, are visuals from New Delhi, where the Prime Minister is currently at the India Mobile Congress. We will, of course, dip into that event, but after this very short break.
Thanks for staying on with us. This is First Trade. Just checking in on some of the newsmakers then in today's trade, and pull up a Colgate for you. Do remember that by and large the numbers did come in line with what the street was expecting, but the volume growth was a little bit dull. The stock just about 0.7% lower. Meantime, you also had a Quick Heal, which was another result candidate, 14% margin, so that contracted to nearly half from what they delivered last year. Revenues as well have been tempered, but despite that, take a look at the stock, 3.5% higher as it's on last count. You've got a Home First Finance as well, another result candidate. Net interest margins have grown about 6%, so that stock continues to remain in the spotlight. A quick check-in on a Kamath Hotels. We don't flag that that off too often, but they have sold their Mumbai unit to Lateral Hospitality for about 125 crores, and that's keeping the stock abuzz in today's trade. What's Vodafone Idea up to as well after their overall numbers, where the margins have risen about 100 basis points? You also had the subscriber base that has grown, albeit very marginally, currently up about 1% or so as we speak. And there's Dixon Technologies as well, another candidate, where earnings were pretty healthy this time around. You had the revenue segment from the mobile segment revenues, which grew about 77% on year. So 5407, that's where the stock is currently at. All right, let's put the spotlight then on the hospitality space, shall we, and discuss the outlook ahead when it comes to chalet hotels, because it has been a pretty tremendous growth that they have delivered in terms of their year-on-year profits, although that has been a little bit below what the street was penciling in. Margins at about 41%, with occupancy growth little changed from last year at about 73%. Sanjay Sethi is the managing director and CEO, and now joins us on the show. Good to have you on board, Mr. Sethi. Thanks so much for joining in. Let's begin by discussing your quarterly performance. It has been a healthy profit growth this time around. Take us through some of the key drivers.
Good morning. Yes, we had again a very satisfying quarter, and it's 5 quarters on a trot now. So things seem to be stabilizing and growing at a pace that is encouraging. We've had a total revenue of about 318 crores, which is roughly 27% higher than the same quarter last year. Our EBITDA at shade under 130 crores is roughly 48% higher than the same quarter last year and 14% higher than the sequential quarter. Margins at 41% are almost 6 percentage points higher than the same quarter last year. So again, healthy growth over there. And the profit before income tax is 2x of same quarter last year. And this is backed by hospitality performance doing extremely well. And, we had 21% growth on the rates compared to the same quarter last year. We've also had some occupancy increase. It's increased by 2% to 73% this quarter. And on a combined or RevPAR basis, the RevPAR is up by 25% compared to the same quarter last year. This is clearly a result which is in line with what the trends have been. And we believe that this is sort of got institutionalized in terms of now steady business going forward.
It is, in a sense, seasonally the best quarter for the hospitality industry. Now, for the quarter gone by, 40% margins, capacity addition, good room rate. So then what happens in this current quarter, which in a sense, you got Diwali, Dussehra, Christmas, New Year's? What happens now?
So, Nikunj, quarter 2 is seasonally the worst quarter of the year, actually. And whilst we'll have the holidays, and our occupancies will dip during the holidays, given that we have our portfolios primarily in the business hotel cities, it will still end up doing better than quarter 2 for sure. And if you look at our historical performance for the past several years, you'll find Q3 outperforms quite Q2 by a significant margin, and then Q4 tends to outperform Q3.
The current quarter, which is October, November, December quarter, is the big quarter for the hospitality industry, for the hotel industry, for factors which we just discussed. Now, what we are discussing, sir, are numbers for the quarter gone by. What I want to understand from you that for the quarter gone by, which is a weak quarter, you've come out with good set of numbers. Now, when the season will kick in, the natural tailwind kicks in, what surprise we should expect from you? See, right now, what markets want to know is the quantum of surprise. Everyone knows that you're in a good spot. Everyone knows that, smiles are back for hoteliers. Everyone knows that, consumers will have to pay more. But shareholders want to know that how much will you keep on surprising us?
We're not in the habit of sharing surprises up front. We don't like surprises as a business. We like business to grow on a steady basis. And that's the trend that we've been noticing for 5 quarters now. And I'm very confident it will continue to grow on a steady basis in line with the current dynamics of the industry, where demand continues to outperform supply by a big margin.
Theory hai. You're giving me a vision statement. Give me some more substance.
We don't give forward-looking numbers. I can't give you any more substance than that.
do you see the trend will last for at least next 4-5 quarters, this uptrend?
Yeah, Nikunj, I do expect the average room rates at least in the business cities to grow in double digits for the next somewhere between 7 to 8 quarters at least, compared to the previous quarter of when you compare them to the previous year's same quarter, and that's backed by the continued gap in the demand and supply situation. And you've got to keep in mind that all the growth that we're showing right now is still in a very VUCA world. The geopolitical world is globally is in quite a lot of turmoil, and yet the hotels are delivering these numbers on the back of very strong domestic demand and return of international business also. So both that combined together give us a strong base to launch the next few quarters from. And going forward, we do believe at some point of time, international travel will also come back. Inbound international travel will also come back with a big bang.
All right, fair enough. That's a pretty strong projection. But what about the outlook then when it comes to the leasing of commercial assets? Because I know that that is one of the key strategies that you adopt. Are you worried that asset ownership with high debt levels could be a risk when we see the industry in a downturn?
No, so look, it's not as if we've got massive real estate to rent out. We've got roughly a little shade under of 1 million square foot at Bangalore, out of which 200,000 is already leased out and occupied. Another 50,000 we signed the term sheet for, and we've had, we're in advanced stages of closing term sheets for another 200,000. So we're getting there fairly quickly in Bangalore. Mumbai, the building is just about getting completed, and once the full product is, for potential clients to see, we do expect traction to pick up. It has been slower than what we expected, but it'll push it back by a quarter or two. We are not worried about having vacant buildings. Let me clarify that.
Okay, great to chat with you, Mr. Sethi. Thanks as always for taking the time out.
Thank you.
From one earnings to the other, let's welcome on board Atul Kumar Goyal, the MD and CEO at Punjab National Bank, joining in on the show right now. Mr. Goyal, tell us about your cost of deposits firstly. When and where do you think they will peak out at?
If you see, the cost of deposit of the bank was around 4.84% in this quarter, as against 4.71% in the last quarter, that is June 23. As on date, around 15% of the total term deposit has to be repriced. That will be repriced at the time of their maturity. So I am of the view that there will be an increase of around 10 to maximum 15 basis point if our entire deposit book has been repriced.
So you're confident of maintaining your NIM guidance, given that the current NIMs right now actually could peak out, and you will be able to deliver NIMs above your guidance?
Yeah, as far as my NIM is concerned, global NIM is 3.11%. Last time also it was more than 3%, but guidance which we have given, our NIM should be 2.9 to 3%. But as far as NII is concerned, net interest income is concerned, that will be positive in the absolute number, because there is some transaction which is available in the market where we are not earning 2% or 3% the NIM. So NIM in terms of the percentage may be little lower, but we will try to maintain even the growth in the net interest income in the absolute number.
All right. Now, the next line item, your OPEX has risen sharply. Can we expect it to remain at these current levels? And what is the outlook in terms of your operating profit? Will that rise in line with the NII growth?
Actually, when we talk about the expenditure, there is a two type of the expenditure. What is the staff cost, or another is the other operating expenditure. If you see our profitability also, there is no much increase in the other operating expenditure, because there is a little bit increase of the 5 to 10% on account of the inflation impact. But definitely there was a increase in the staff cost, which is normally in the non-controllable in the nature, because from the November 22, there is a wage revision is due. So what we have done, if you see the earlier quarter, we have provided the area wage revision within the range of the 280 crore rupees per quarter, which was around 10% of the wage hike which we have presumed. But if you see the last bipartisan settlement, there was an increase of the 15%. So this is the reason, instead of the 283 crore rupees which we have provided in the last quarter, we have provided 694 crore rupees in the current quarter, taking the impact from the November 22 to this up to the September 23. But as far as AS15 provision is concerned, because there will be a decline in the AS15 provision because the rate has become harder in times to come.
Sure. Mr. Goyal, tell me about your credit costs, because they've now slipped below the 1.7% mark guidance. Is 1.3, you think, a sustainable number?
Yeah, definitely it will be very sustainable also, because if you see the first quarter, it was 1.98% credit cost, but in this last quarter, September quarter, it was 1.31, and the half yearly it is 1.67. So this is very much maintainable, because reason behind it, because if you see last 5 to 6 quarter also, the slippage has reduced drastically. It is on account of the fresh underwriting. I would like to give one more data also, because every month we are monitoring this new acquisition. From the 1st of the July 20 to 30th September 2023, around 6.68 lakh crore we have sanctioned, out of which 5.97 lakh crore we have disbursed. The outstanding of this loan is 4.63 lakh crore, where the NPA is hardly 1,314, which is coming around 0.22%. So this new book is giving the comfort that there will not be a further slippage. I can give you further the segment-wise slippage. The agriculture is at 0.23, and the retail it is 0.18, and MSME it is 1.47. When we talk about the corporate, it is only 31 crore rupees out of the outstanding of the 2.73 lakh crore. So it is negligible, 0.001%. Yeah.
Net NPAs have fallen dramatically. Recoveries is the only contributor. Are there any of the factors? How quickly do you expect to get to 1% NNPA numbers?
There is no adjustment in the net NPA. It is on account of the recovery and the provision which we have made. There is no other thing also. As far as your point is concerned, we have given the guidelines. We will be in a position definitely to bring the net NPA less than 1% by the March 2024, and we will maintain our guidance also.
22,000 crore of recovery. Are you confident of this? Talk us through about the recovery through the NCLT, and will recoveries be more than the net slippages?
Yeah, we are maintaining our guidelines, because 22,000 crore rupees we have given the guidance for the whole of the year, and around 11,000 crore rupees, little less, we have already achieved. Because why we are telling we will be in a position to achieve the 22,000, because there is some of the recovery in the NCLT account, which is expected to recover in the current quarter. Because if you see the first quarter, the recovery from the NCLT was 566 crore, and second quarter it was 556 crore rupees, and we are hopeful. We have made a list also. I think 2,500, I think we should recover in the current quarter from the NCLT recovery, and around 1,000 crore rupees we should recover in the last quarter of the current financial year. So we are confident, whatever the guidance we have given, we will be in a position to fulfill that 22,000 crore rupees whole of the year.
Right. There have also been some concerns on unsecured lending from you. What part of your mix is currently unsecured, and any risks that you foresee on the portfolio?
As far as unsecured book is concerned, that is very minimal in the Punjab National Bank. The total unsecured book is around 27,000 crore rupees, and in addition to that, 4,000 crore rupees is the loan to the pensioner, where the cash flow is coming there, pension also. So 27,000 mein, the hardly 17,000 crore rupees is the personal loan. Out of this personal loan, around 4,000 crore is the digital, and remaining 13,000 crore rupees is the through the other channel. In this 4,000 crore rupees, the delinquency is only 0.41%, and the total delinquency in the total personal loan is hardly 1.22. So we are not seeing any challenge for the recovery in the any unsecured loan book in the bank.
You've achieved a record quarterly profit. How quickly will you get to the 1% ROA mark?
The ROA, if you see last year, the full ROE was 0.17, and we have got the guidelines that this year it will be double. But already, if you see the last quarter, it was 0.46. So 1% ROA, I think we will be in a position to definitely achieve by the exit of 24-25.
Right, sir. Great to have you on the show, Mr. Goyal. Thank you so much for taking the time out and joining in. Well, as you can see, all excitement in Delhi right now. It's the biggest telecom event in the country. From the biggest leaders to corporate honchos like the Ambanis are all going to be attending the event. In fact, the India Mobile Congress also has the Prime Minister in attendance. He's going to be speaking shortly. But firstly, let me take it across to Sumita, my colleague, who's currently there. And she joins in to tell us what's on the agenda.
This year is going to be, the theme is global digital innovation. Innovation is the key based on which our startups are doing so well. We have seen our whole ecosystem has changed. Fintech has gone to the masses. So everything which is linked to telecom is clearly here. We are going to see how it's going to be taken to the masses, not just to the elite public. And we are here in the Bharat Mandapam, which is going to host all these big telecom czars, so-called Mukesh Ambani, Sunil Bharti Mittal and all. And it's a place where we actually saw G20 happening. Absolutely. And now it's going to be a place where PM may announce some things for the masses, things will come, but the key is going to be the digital innovation. Let's talk about the place. It's actually a grand place.
Right. So in fact, if I could ask my camera person to pan over and show how big, how humongous the hall is, because remember, 1 lakh plus participants, over 400 speakers are coming, including startups from 31 countries. Like I said, last year, the big leap was around 5G. Ericsson recently hailed India's 5G as one of the fastest in the world. Last year was all about the 5G rollout. But this year will be all about how telcos really capitalize on the 5G network in India. Remember, there will also be sessions around innovation. There will be sessions around cybersecurity, around data protection, around 5G, 6G also, because remember, the Prime Minister laid the roadmap for 6G earlier this year. So all of that is going to be the focus area.
And one focus point will be consumers. 100 crore subscribers we have almost, and they are using telecom services. Let's talk about dropping of calls. It's really a problem. Pesky calls. When we talk about telecom, these things come to our mind because consumers are definitely troubled by these call dropping, troubled by these pesky calls. So consumers are also going to be a big focus point in today's India Mobile Congress.
Absolutely, and last but not the least, the focus is going to be on how these telcos really are able to monetize 5G, because remember, capex spends have been huge, humongous in the past couple of months due to the rollout of 5G. ARPUs will have to be better. So we'll need to actually hear from all of these big telcos on the road ahead for all of them, for the telecom ecosystem in India going forward.
Absolutely. So we are going to bring everything from here to our viewers today and tomorrow and the first 3 days. Clearly, it's going to be a big action-packed event, Asia's largest currently on telecom sector. We'll be bringing all to our viewers.
Big congregation of corporates in India, and it's the India Mobile Congress at Bharat Mandapam, where by the way, a couple of weeks ago the G20 was hosted. Sanjay Shah joins us, Chairman and Managing Director of Prudent Corporate Advisory Services. Sanjay, good morning. Thank you for joining us. Okay, your business is growing because SIPs are growing. Indians are investing more in mutual funds. Indians are moving from real estate to financial assets. That's the big picture. Markets like it. The stock is up. But my point is the SIP basket is growing, then why are your yields declining? It should be the other way around, right? Operating leverage should kick in. You are getting more business and yield should go higher.
Yeah. So I think, thank you for calling me. It's a very important point because, Nikunj bhai, there is a significant change which has occurred as far as entire revenue is concerned, as far as mutual fund distribution business is concerned. So as you are aware, in the last year, March, SEBI has capped the B30 revenue in abeyance. And if I'll give you the numbers, last year we earned about 500 crore from the mutual fund distribution business, wherein almost 40 crore came because of our business from beyond 30 cities. We are purely a very retail distribution house, and that entire 40 crore has gradually moved away. So in the current year, B30 revenue is not there. And if I'll just give you the, let's say, perspective of my last quarter, agar B30 continue hota, so we would have on another 7.5 crore additional revenue. So if you look at overall average AUM has grown by 29%, my top line has grew by only 24%. So that 5% change which has came mainly because your B30 revenue has been out of the picture. So it's a long-term change in the revenue. So I think my yield is now, which used to be about 95 basis point, is now going to settle in the range of 87, 88 basis point.
I wanted your perspective on the SIP number. We feel very happy about SIP number every month, 15,000, 16,000, hopefully 20,000 crores soon. But that is not the net inflow number, right? Net inflow number is always SIP inflow minus outflow, which includes SIP inflows minus outflows, which the industry has. My understanding is that the outflows actually have started increasing and the net number is decreasing. Is that true?
Probably, if you look at the first quarter of current year and the second quarter of current year, actually our net sales number were very, very low in first quarter, which was hardly about 800 crore, 700 crore. We did almost 1400 crore plus net sales in July, August and September. So net numbers are reasonably healthy. Other way, if you look at, if I bring in two SIP, there is one SIP closer. So that number is also in line with, अगर मैं नई SIP अगर 10,000 लाता हूं तो 5,000 रहती है, 5,000 closer होता है, और there might be renewal of SIP of 50%. So overall, I don't think there is a significant change as far as retails are concerned. So rather July, August, September number were good. October again we are seeing some amount of consolidation. But frankly, I believe that some amount of consolidation on the new money which is coming in, and this correction will probably become more and more healthy, and this book will become more stronger over a period of time if market correction is absorbed by the retail investors.
Do you see a big uptick coming into your business simply because a lot of new NFOs have started coming in? Every second day there is a new NFO, whether in the bond market or fixed income, or for that matter, sectoral schemes like defense and railways.
So I think though probably a lot of NFOs are coming in because AMC wanted to fill their gap and wanted to have the entire basket available to the investors. However, if we look at off lately, I think the craze for investing in NFO has been gradually decreasing. And normally it used to be a very big area for marketing and reaching out to the retail, but now probably people are comfortable investing into existing schemes. So I don't see significant money coming only because of NFO. Regular money in the regular scheme is also coming regularly.
Okay, great to have you then on the show. Thank you so much for highlighting, Sanjay, how your earnings have been, what the visibility looks like. Let me quickly take stock of where the market as well has settled in at. It's been a decent recovery, aligning ourselves with the rest of the globe. So a touch and go moment with that 19K mark. But yeah, fair enough. We've lifted about almost 100 odd points from the session lows yesterday, given that even breached that 18,900 print in trade in yesterday's session. Shriram Finance, that's the one which is up almost 8% right now. What an earnings reaction coming in. It's a big beat all across parameters. Let me welcome on board Vyas Chakravarti, the MD and CEO at Shriram Finance, joining in on the show right now. Mr. Chakravarti, great to have you today on ET Now. Your AUMs have been consistently growing at 19% in the last 2 quarters. Given that typically second half is better than first half, do you think that you'll be able to beat that 19% figure? And is 20% thereabouts a fair assumption?
Yeah. I think we should be able to do that. Should be able to beat it. As you said, the third and fourth quarters are good seasons for a business. So hopefully we should be able to cross this 20%.
You've been seeing growth across segments, right? Your PL, PVs, gold, MSMEs. But the CV segment, that has been a little bit soft. Tell me, what's your expectation about there? What kind of disbursements are you anticipating in the second half? And will the other segments keep firing up?
On the CV side, we have guided for about around 12-13% growth in the beginning of the year. And I think we are on target to that. So CV will grow in these 2 quarters. I think we will be looking at about 15% growth in the CV. But the rest of the segments, being the base is small, I think they will outpace the CV growth, particularly our MSME portfolio. And of course, the one segment that is actually performing really well is the construction equipment.
Aren't you diversifying too much? Because Shriram Transport Finance has always been a specialist in the second-hand CV market. You understand that business, risk, both borrowing and lending. But now you're diversifying into a lot of other segments. Isn't that saying that you're spreading yourself too thin?
I wouldn't put it that way because after the merger, we also have teams that can handle MSME, gold, and two-wheeler. Basically, the merger with Shriram City Union Finance. So, Shriram City Union Finance is also doing this business for the last 25, 30 years. So we have teams that have expertise in running these verticals. So I don't think we are. I mean, even with all that, if you look at it, non-vehicle business is still only 20% of the portfolio.
Okay. When you say second half will be better, I'm assuming that you are referring to the non-CV business, because it is not like that the CV business will become better in the second half of this year. I mean, this has been a natural uptrend throughout the year now.
Yeah, non-CV business, and the CV business we expect to do well in the fourth quarter. Typically, a lot of corporates and all acquire new stock in the fourth quarter. So we expect CV business also to do well in the fourth quarter.
Okay. So in light of that, what is the outlook when it comes to your net interest margins? Because they have expanded on a sequential basis. What is driving this improvement, and do you think they look sustainable at the current levels?
What is driving the net interest margin is two things. One is we had liquidity buffer earlier, which we have reduced it to 3 months now, 3 months of liability. So that about 2,000 crores came off. So the negative carry has come down, one. Second is the change, the mix of disbursement, in the sense our SME has gone up, which is like giving a slightly higher, NIMs compared to the CV segment. So it's a product change, slight change in the product mix has aided this. And as far as sustaining it is concerned, see, third quarter, fourth quarter, because the demand and since we offer schemes to customers, particularly in the two-wheeler segment, and of course, going forward, we are also, as a new CV segment is slowly increasing, the NIMs could be anywhere between 8.5 to 8, whatever 8.9. It could be in this range.
Can you grow at 20%, the number which you shared with us, without raising capital for next year?
Yeah, we are at 21% capital adequacy. I think we should be comfortable. Probably next 2 years, we may not need capital.
Minimum capital you need to maintain, because banks I know the number, NBFCs I don't know the number. I'm not aware of it, let me put it
15%.
15%.
Yeah.
Okay. So if you're growing at 20% and your capital adequacy is 21%, that means for at least 3 years you don't need capital, because you'll plow back your profits back.
Exactly.
Okay.
That's what I'm saying.
If that happens, then what happens to your return ratios? The return on equity should go higher, because if you're growing without diluting, then return on equity should go higher.
Correct. The ROE should trend up.
I'm learning the tricks now. How to analyze NBFC. I'm learning the tricks now, how to analyze NBFC businesses. Okay. So then what happens when you are, what is your leverage ratio right now? I mean, in terms of the balance sheet leverage.
I think we are at about 4.5 times, roughly. 4.5.
Isn't that slightly high?
Oh, I think, no, probably, see, if you look at it, we will be comfortable at about 5.5. Around 5, we should be okay.
It means that you can then be 20%, because if you're looking at taking leverage higher and growth is looking strong, that means 20% is the base. I mean, then you should be giving us numbers which are north of 20%. I mean, looking at what you just told us.
I'm sorry, I didn't get you.
No, sir. I'm saying that you have a leverage which is comfortable. You want to increase your leverage. You're talking about a 20% growth. But looking at how positive you're sounding, and the festival season is around the corner, that means the second half of this year, you should actually give us numbers which are north of 20%.
Possible, but see, what I'm looking at here is this 19% is aided by mostly by my construction growth in passenger vehicles, construction equipment, and MSME segment growth, where I would like to take a slightly lower targets on the passenger vehicle as well as the construction equipment. MSME will still grow at the same rate. So looking at all this, conservatively, I'm putting it at 20%.
All right, appreciate your time. Glad you could join us, and certainly hope to see much more of you going forward. It's the stock of the day, Shriram Finance. Yes, no, yes, no. There was a lot of overhang. Now the merger has gone through, new businesses are getting added, cost of liabilities are getting better, and NIMs are going to expand. So it's a stock to watch now going forward, and that's what most of the brokerages are saying. Let's take a break with the news that markets are looking steady. A gap up start which is sustaining, and the breadth is looking powerful once again.